So what I'll talk about today is how risk transfer can assist the adaptation situation for agriculture, particularly thinking North Queensland. But what we're all most used to is, of course, indemnity-based insurance, where the claim is paid out on the damage. The payout is made on the damage to the property usually, and an assessor comes out, inspects the property, or your car's damaged or whatever, and the claim is made based on the damage itself. That's called indemnity insurance, and that's the conventional way of insurance. Hasn't worked at all in Australia for, well, I'll call it crop insurance, but we include pasture, anything related to any of the risks involved in agricultural insurance has not been successable from an indemnity or the claims damage. There's some risk like hail damage, hail or fire that the conventional indemnity insurance applies to, but it's a slow process, and it's an option, but it doesn't cover enough of the needs of farmers in Australia. And hence the projects I've been involved with DAF and University of Southern Queensland, Queensland Farmers Federation, National Farmers Federation, and CSIRO to come up with more sustainable, more affordable methods. So that's the lead in, and a little bit of setting the scene, if I may. I'll just jump to the next slide. Great. So setting the scene, the right-hand side's a little bit out of date now. It was 2020 main global risks, and maybe number one was the failure to recognise climate change and adaptation. Maybe number two is nearly moving up to number one at the moment, sadly, but that's the biggest global risks concerns across the world in recent years. And as we all know, climate change is a massive one. So without spending much time on these, we all know about adverse weather in Queensland. The droughts are massive Australia-wide, and the cyclones we experience. And the second point, unfortunately in Australia, unlike America, we get 65% of their crop insurance subsidised by the government, going back to the 1930s when they had the Dust Bowl. We don't get subsidies in Australia for insurance, and there's no signs of that changing in the immediate future. So we have to find ways of being more competitive and filling farmers' needs. The next one, the take-up, as you'd expect, because of the cost and various other reasons of insurance, is extremely low. As Cherie mentioned there before, it's post-event protection payouts that farmers rely on, and it's up to 75,000 payouts in both from Q Rider and from the government, federal government side. And the cost, again, to government is quite significant. So whether that changes over time, we don't know. But at the moment, there's 97% of Australian farmers remain uninsured, and we're talking agricultural insurance. Just jump to the next slide. I need to spend much time there. All the challenges we have across Australia, we know all about them. So they're the things we're trying to get some sort of protection for. I'll jump to 4, move to 4. How can we respond? When we talk about agriculture in Australia, farmers have had to be very strong in their knowledge, and there's no greater experience than a farmer's experience. So they know how to manage risk from the hard facts of having to get through season to season and all the challenges Australia's weather produces. So they know about maximising yields, reducing cost of production, climate forecasting, forward pricing. Even they know as much about that as you'd expect. And really, insurance is low on the priorities, as we all know. It hasn't got the greatest name with farmers generally, because in a lot of ways there's a lot of mistrust. Some insurers have come out, particularly of agricultural insurance. The cost is not seen as palatable for farmers, and as a result, there's lack of and there's also a lack of insurance products, and the awareness of what those products are is lacking as well. So that next point, the third point, there needs to be, and that's what we've concentrated on, a real integration of that risk management process, as well as a risk transfer or insurance setup that doesn't try and be everything to everyone, is more a extreme weather event type coverage. And in other words, the sort of worries that they keeps farmers awake at night. Get that insured, and they're aware of that side of things, and the rest of it they can manage themselves. So that's what we've concentrated on, the real extreme weather type of event. And that's what the Future Drought Fund is, that final note there that Marcus would be well aware of. And we've been working with JCU's Future Drought Fund project, and also with University of Southern Queensland's project in assisting there. So that next one, Parametric Solutions, and that's the approach that we've concentrated on through these projects, is what's called parametric solutions, or insurance, or index based. So it means the same thing. And really the difference is it's very simple in its concept, in that the payout is based on the event occurring, a defined event has occurred, rather than the damage that the event causes. For example, for a drought type of cover, rainfall cover, less than 50 millimeters of rainfall in a certain period, or for or in a cyclone, for example, category 3 or above, if that passes within, you'll see an example of that within your property, then a payout is made. So you choose the limit that you want to have covered, rather than having to cover all the total value of your crop, and therefore there is some payout. Maybe it's just enough to cover cost of production, keep the business going, and that's the approach. And it can be set up to the farmer's own, to suit the farmer's budget, and it can sit, third point there, parallel to any existing farm normal indemnity or farm insurances, farm pack type covers that the producer might have. No need to spend, the bottom one just talks about all the different types. You can have different index-based ones, look at rainfall, temperature, all sorts of things, and event-based, which are more for cyclones, volcanoes, etc. The concept very much used right around the world, particularly in Europe and America, but it's really something mainstream Australian insurers haven't got their head around, if I can put it that way. You can get parametrics, and that's what we do in Australia, but generally it's not a readily accepted approach for insurance, and maybe that's because of the lack of appetite from farmers and lack of awareness, which we're working on. Okay, so the benefits, just briefly, the program, it's tailored to reflect, as we mentioned, wherever your location is. So you can imagine if you're in North Queensland, the exposure for cyclones higher, so the insurance rate's going to be higher. The risk exposure, the risk appetite, so it allows for whatever the farmer wants to get covered, how much of an area, there's different levels, choices that you can make, and whatever the budget is. So if the budget's $5,000 premium, that's all a program is designed then around to suit whatever the premium needs to be paid based on the risks of the weather at that location. No exclusions, unlike, that's why I said it's very simple insurance, because you don't get all that challenging exclusions where you need to read all the fine print with any general. And keep in mind, my experience is general insurance, so I know exactly all the exclusions, are very much aware of what clients have to go through to understand exactly what the policy covers. So you avoid all that. Payouts are very quickly made as soon as the weather is confirmed, the reading, and BOM is the reader in Australia that is relied upon, then the payout is made immediately. So usually within 2 or 3 weeks, the farmer gets his money to use for whatever purpose. no loss adjusters waiting for the assessor to come out, and there's no restrictions in what the payment can be used for. It doesn't have to be used to make good the damage, presuming they have had damage. It can be whatever's required. So just that final bottom point, it mentions, for any of you who are not aware of what's called basis risk, and that's the risk where the index that's being set up in the policy doesn't actually reflect the actual risk. To give you an example of that, you might say if less than 50 millimeters of rainfall is what I'm insured for during a particular month, because that really is your key growing period. If it happens to be 51 millimeters that's red at the bomb reading station, the claim is not paid. Now, you might have had damage and right on the verge, but that's what the parameters are. So that's called basis risk. And even though that applies in parametrics, it really applies in general insurance as well, because you might think you got a claim, but you suddenly find out flood's not covered, or the excess is not the claim out, those sort of things. But that is the what's called basis risk in parametric insurance. And the thing is that BOM are trying to, and the first gentleman would be well aware of this, that looking to have been working for several years on trusted private automatic weather stations, and they're being rolled out now to far increase the number of weather stations readings that they'll accept and that insurers will accept, which will reduce that basis risk exposure dramatically. Yeah, parametric insurance example, drought. So just talking along the lines that I was before, if you look at commencing the cover on the left box, 50 millimeters through to no rainfall at all, and $1,000 per millimeter where the rainfall is less than 50 millimeters. And it goes the same way if you could imagine exceeding a limit for the flood side of things. So in this case, less than 50 millimeters, you can see that 2005, 14 and 17, that's what this runs up to. There on the third box or graph, you'll see there would have been 3 payouts made in 2005, about 27,000, 1,000 in 2007, and about 9,000 in 2000. There would have obviously been one a bit after that, but it's in 2021, but it's not shown on this one. But that's the basis of how that works. The soil moisture here. So soil moisture, another example of parametric insurance, which is fairly new to the stable of the types of covers, and they're coming up, and I'll mention something a little bit later that we've done innovative in parametrics, because anything that has data and that you can measure and set up an index can get parametrics cover. Footfall through a sporting ground or a airport affected by rainfall, that it might affect, or an earthquake that could affect the footfall. Well, then using that footfall knowledge, that can be converted into a parametric insurance cover. So it's wide, flexible usage, which makes it more appealing. So this one here is just to do with soil moisture, and it's based on satellite readings. Not totally au fait with all the technology that goes behind it, but there's 40 years of data sitting behind what the insurers provide quotes based on this data, these data, and therefore if the soil moisture reading is in levels that would be below what the farmer was needing in a certain period, in this case we're talking July, August, September, you can see all that, and you certainly have a certain attachment point, say 50, and in this case, it's not millimeters, but it's cubic meters is what we're talking about, and the quantity of rainfall within those that soil below, I think it goes down to about 5 centimeters, something like that. So it's not that deep, but it gives a pretty good reading on what the exposure is for the soil for the growing of the risk. So the bottom one, you can see in this particular case, the farmer has chosen to insure for any rainfall, a soil moisture deficit worse than 50 millimeters up to 150 millimeters. And he would have had payments in in the mid-90s. Was the next one, early 90s, 2004, and then 3 in 2017, 18, and 19. He would have had payouts. We haven't related dollars to those, but they would have been, they'd be based in the same as the previous example, depending on what amounts he chose to have covered. So that's the soil moisture, because when I've talked to people about the rainfall, they say, well, the rainfall's fine, we get a big downpour, but then it just washes off, and you'd experience that, and then it means nothing for the soil moisture and the growth that's needed from that. So this gives you that. That's another alternative for the cover. The next one, and I'll just jump onto that, is more a prototype, and Yvette at JCU would be familiar with this one, Marcus, in that we put together a partnership potential proposal to her. And I'll read it out a little bit because it's easier. I've sort of put down the main points. The goal is in-season payouts in the event that severe drought conditions result in insufficient pasture for grazing, ensuring graziers have cash in hand when they need it most, not after the damage has already been done. So using cutting-edge satellite technology to gauge the availability of forage for pastoralists is how it's done with satellite technology. And you'd probably all be familiar with NDVI is in the predetermined regions and periods with triggers calibrated to ensure payouts are triggered when animals will start to be stressed due to inadequate nourishment. So if the NDVI reading is below a certain pre-agreed level, then the payout is made, and it can be paid out as the period that you select goes. So if a farmer wants to restock with feed, that can be taken up rather than waiting to the end of the season when unfortunately they've lost so much value for the grazier. Now, this is already tried and tested through our people in this what's called a satellite index insurance for pastoralists in Ethiopia. It was funded by the World Food Programme, and we facilitated the program. So again, the difference there is that the subsidy makes it a much more attractive proposition, but the concept's there and can apply to grazing for North Queensland if we wanted to go down that track. And to my knowledge, it's not a tested and approached in Queensland. And as I mentioned, we raised it with the Yvette in the possibility of it being a project for JCU, but to get a research grant to do the research on the concept. But I don't think Yvette's heard back yet, because data is the key, and data research would be so much involved. But just while I'm talking on that, I'll just touch on an example which we have done in North Queensland, and I work with CSIRO with this project. And Yvette, again, keep mentioning her name. She knows Dr. Peter Thorburn well from CSIRO, where she used to work. But we got together with their idea of designing a nitrogen fertilizer risk insurance related to cane farming for the wet tropics. And it was funded by the Great Barrier Reef Foundation. They were concerned about the flow of nitrogen into the water surrounding the reef and the increase of crown of thorns starfish and their damage to the reef. So as a result of that Peter's concept, we talked to insurers, could there be a cover that if cane farmers are prepared to reduce the level of nitrogen, which, as you know, they probably put a little bit more on to ensure yields are what they should be. I probably shouldn't say that, but perhaps it happens. Reduce that yield and a cover that should there be reduce the nitrogen, which at the end of the harvesting period results in a loss of yield. Could there be a cover that if that's the case, the nitrogen is reduced and there is a loss of yield, that they would get a payout? So we've actually now commercialized, it's only just started a couple of months ago, a product which covers cane growers for that loss of yield as a result of reducing their nitrogen. So it's an example of parametrics. APSIM, I don't know who's aware of the APSIM modelling, but that's the modelling which is CSIRO partner in, and it's seen as one of the global leaders in global modelling, and has been the ideal and something insurers have accepted. And it's Liberty International are the insurers for the project, and just got it started, but it's been taken up. Quite a lot of policies have been taken up. So any ideas in that area can always be considered. So I'll just jump on to the next one. Too much further. It should be 10. As you mentioned, bushfire. Has that come up, bushfire? Yep. Correct. Bushfire. Again, very similar concept. Rather than someone, the actual damage caused by the fire gets assessed by an adjuster, and it takes a long time to work out how much was actually burnt. This process uses satellite. It looks at what undamaged forestry was there prior to the bushfire, and then the reading after the bushfire. A formula is set based on what the loss would be if there is a loss, and the calculation is done and the claim settled based on the difference in what's the two different colours, I guess. Sounds very simple, and I believe, apart from what goes into the underwriters' minds in knowing about shape maps and all that sort of thing, which they need to get to price it, that's the basic concept of what they do. And this is a particularly existing, the one we got up there is an existing case study of an existing client, happens to be in Victoria. Just looking at characteristics, the limit of the cover, they've got $20 million cover for their forestry. They've got to pay the first $250,000 of any claim, and the rate is around 3% of whatever sum insured they choose. So, for example, 100,000 would be 3,000, $1 million would be a $30,000 premium. So, and again, another cover where they did have a fire in recent years, this particular insured, and could not get cover in the general indemnity insurance market. So, a parametric worked for them. I'll just touch on the last area, which is cyclone. Again, we've done a lot of work in the cyclone area. Quite simple to formulate a parametric for that. And if you just look at that map there, an indemnity zone is agreed. So in this case, around the Mackay area there, if a cyclone of greater than category 3 passes within 50 kilometres, I'll show you in a moment what this has relevance to, within 50 kilometres of the farmer's property, and the payout amount is agreed beforehand, and that's what the bomb reading says, the payout is made straight away. If the cyclone, the eye of the cyclone enters that 50-kilometre radius. So nothing to do with damage. The damage doesn't come into it. You presume they would have had damage, but that 50 kilometres doesn't have to be 50. It can be 100, which would be more expensive, can be 200, and that's not an uncommon cover that's taken out these days. And the next one there, I'll just touch on this as the final slide. This has to do with what we did for cane growers, where we put together, because of their 12 cane growing regions where the mills are located up the coast, we put together what's called a discretionary mutual fund, where there's group buying power advantage. And obviously it's not going to be a cyclone in every one of those locations, but how we worked it out was that we said if each farmer had $50,000 worth of cover, can have various increments of 50,000, and a category 3 passes within 50-kilometre radius, the total loss would be that top amount, 27.5 million, if everyone had a loss of the 20% we estimated in the initial stages. But more likely, it would be far less than that. So what's set up down the bottom is what's called a member-owned mutual. In this case, we've used as an example 5 million. So the farmers contribute to that 5 million, and that's what they must pay up to. In the event of a cyclone, the farmers have to pay up to the first 5 million. Part of the payment of going in setting that 5 million up buys the 12 million in excess of 5 million. And then we leave the top part because it's terribly unlikely half a dozen cyclones are going to strike in the same year. This is annual. So the first 5 million, the attraction is if a cyclone doesn't hit, that 5 million in the fund belongs to the members and can then roll over into the next year and the year after. So let's say that had been rolling through now for several years, there'd be a substantial fund build up, which would reduce the amount of the insurance purchase, that 12 million above it, to such an extent it had been going for quite a few years. It could become totally self-insured and just maybe need a little bit of top-up cover right at the top. So it's a fantastic proposition. We went to Queensland Treasury with it and with cane growers and QFF, but so far hasn't liked the concept, but hasn't been got serious acceptance yet. I think political issues might be the concern. The worry about other industries wanting to get contributions as well, because just to mention that 5 million, farmers don't want to contribute all of that 5 million. If you want to keep it competitive, they might only want to pay, say, 3 million towards it. That means it needs capitalising for the other 2 million on top of that. But it's only a loan, as we tried to explain to the government. If the cyclone doesn't happen, then in the early years, then no payouts required. So the money just sits in escrow and there's no loss. So a concept that we think in time, again, very common in America and other places around the world, these mutual approaches. And I think we'll see a lot more of it as the industry gets more aware of what's available. And after all that talking, thank you very much for listening, and very, very happy to answer any questions.